Hey, fellow investors. Have you ever wondered how some people seem to spot hidden gems in the stock market, even when everything looks chaotic? What if I told you that market volatility isn't just a time for panic, it's actually a season of opportunity for those who know where to look? Today, let's talk about 7 value investing strategies I use to spot opportunities when the market is anything but calm. First, let's address the elephant in the room. When markets are volatile, most investors feel the urge to run for the exits. But history shows that panic selling is often the worst move. Instead, I see these moments as a chance to find strong companies that are temporarily mispriced because everyone else is freaking out. Think about it. When the market is in a frenzy, even high-quality businesses get tossed aside, just like what happened in the US market during previous panics. Entire sectors can be dragged down, and that's when I start paying attention. Have you ever bought something on sale just because everyone else was too distracted to notice the value? Now, how do I figure out if a company is genuinely undervalued? One of my favorite tools is the discounted cash flow DCF model. It's a bit like using a crystal ball, but instead of magic, it's all about math. The DCF helps me estimate what a company is really worth by projecting its future cash flows and discounting them back to today's value. For example, if a company is expected to generate $50,000 next year, $60,000 the year after, and so on, I'll discount those amounts using a reasonable rate, let's say 8%, to see what all that future money is worth right now. If the sum is higher than the current price, I know I might have found a bargain. Have you ever tried valuing a business or even a side hustle using future cash flows? But numbers alone don't tell the whole story. I always look for companies with consistent cash flow and low debt. Why? Because businesses that generate reliable cash and don't owe too much are better equipped to weather storms. Imagine a company that brings in steady profits year after year and doesn't have creditors knocking at the door. These are the kinds of businesses that can survive downturns and come out stronger on the other side. Think about your own finances. Wouldn't you feel more secure with a steady paycheck and minimal debt? Another thing I watch for is high-margin businesses with real pricing power. This is a trait Warren Buffett loves. Companies with pricing power can raise prices without losing customers. Think of beloved brands like Coca-Cola or Apple. They can maintain or even grow their profits, even when costs rise or the economy slows down. If you see a company consistently posting high profit margins compared to its competitors, that's a big green flag. Can you think of a brand you'd stick with, even if they raised their prices a bit? I also keep an eye on insider buying. When executives and directors are buying shares in their own company, it's usually a strong signal that they believe in the business's future. After all, who knows the company better than the people running it? Insider purchases are public information, and seeing multiple insiders buying at the same time can be a powerful vote of confidence. But remember, it's just one signal. Context matters, so I always look at the bigger picture too. Have you ever checked if the leadership of a company you're interested in is buying their own stock? Dividends are another key clue. I love companies with a long history of paying and ideally growing dividends. It shows stability, discipline, and a commitment to rewarding shareholders. Some firms, like Procter & Gamble or Coca-Cola, have paid dividends for over a century. That kind of track record doesn't happen by accident. It's a sign of a resilient business model and strong cash flow. Do you prefer getting steady dividend income, or do you focus more on growth stocks? Now, here's the hardest part for most investors: patience. Value investing isn't about quick wins. It's about letting time and fundamentals work in your favor. Sometimes, the market takes a while to recognize a company's true worth. I've learned to trust my analysis and wait, even when prices move sideways or dip further. As Warren Buffett says, you don't need a super high IQ or inside information, just a sound decision-making framework and the ability to keep emotions in check. The fundamentals take time to show up in the share price, but if you've done your homework, patience usually pays off. How do you stay patient when the market tests your nerves? Of course, none of these strategies work in isolation. I always make sure my portfolio is diversified across sectors and regions. Diversification helps smooth out the bumps. If one area struggles, another might pick up the slack. It's like not putting all your eggs in one basket, a classic rule that stood the test of time. How diversified is your portfolio right now? So to recap, I look for strong, temporarily mispriced companies, use DCF and other intrinsic value models, focus on cash flow and low debt, seek high-margin businesses with pricing power, watch for insider buying, target companies with strong dividend histories, and, most importantly, I stay patient. Value investing isn't flashy, but it's proven, especially when markets get rough. If you found these strategies helpful, or have your own tips for finding value in a volatile market, I'd love to hear from you. Drop a comment below, share your experiences, and let's learn together. Don't forget to like, share, and subscribe for more investing insights. And hit that notification bell so you never miss an update. What's your favorite value investing strategy when the market gets wild? Let's chat in the comments.